Welcome to FAM Fund's podcast series, where we speak with senior portfolio managers and investment professionals. Our goal is to provide investors with unique insights garnered from our bottom-up, in-depth research process. We hope this information is beneficial to you. Thank you for joining us.
Hello, I'm Ann Putnam, Senior Vice President of Fenimore Asset Management and FAM Funds, and I'm joined in the studio today by Drew Wilson, who is the co-manager of our FAM Value Fund, as well as a research analyst on the team. He's been with Fenimore for 7 years and has industry experience dating over 20 years. Drew, thanks for being here.
Happy to be here, Ann.
Excellent. Today, we'll talk about a number of things concerning the wealth effect. For one, we want to understand how our analysis of the wealth effect impacts our bottom-up approach. We also note that with the market momentum of 2017, there are impacts that suggest differences for the outlook in 2018. Today, Drew's going to help us define the wealth effect, and I'll have him give some of the theories behind it as we get started.
So the wealth effect is the theory that as a person's assets grow or appreciate, that person, in economic terms, has a higher propensity to consume. Just simply stated, when a person feels wealthier because their assets grow, they spend more. Generally, the two largest assets a person has is his or her home and his or her investment account, or his or her financial assets. So we typically talk about the wealth effect in terms of stock market and home values. As home values go up, homeowners spend more. As stock prices go up, investors spend more.
So as the discussion around the research table spoke to the wealth effect and the theory of how it might have some dynamics within consumer spending, both on investors' appreciation in their portfolios as well as home valuation, can you help us understand further which is most important?
Sure. Most studies have found that the wealth effect is greater for home appreciation than it is for stock appreciation. Some of the studies showed that for every dollar of home appreciation, the average homeowner spends 8 cents more. Conversely, for every dollar of stock portfolio appreciation, an investor spends 3 cents. So you see there is a big difference between the two, but they both affect consumer spending to a pretty high degree.
Given that consumer spending is an important concept for our analysis of individual securities within our portfolios, what other things might be affecting consumer spending as we look toward the future for our oversight?
So there's a lot of things that affect consumer spending. First, and probably most obvious, is whether the consumer has a job and what their wages are. But it's not just their current wages. It's what they expect to earn in the future. So if their friends are getting 2, 3, 4% raises, or their colleagues are getting 2, 3, 4% raises, they'll increase their spending even before they get a raise. In addition to that, it's their after-tax, their disposable income after they've paid their taxes. So as I said just recently, most households got a nice tax break or a raise in their disposable income. So that's also going to contribute to more consumer spending. In addition, it's their ability and their willingness to take on debt or credit. And as we've seen, credit standards have gotten looser and the consumer has been more prone or more accepting of debt. So that's also going to add to consumer spending. And then finally, it's just how the consumer feels, his or her confidence level. And recent studies have shown that consumer confidence is as high as it's been since 2001.
So I'd imagine that there might be a causation that occurs in a savings rate decline, because as consumer confidence increases, we see the wealth effect play out within the marketplace, that savings is then at a lower rate today?
That's exactly right. So if you spend more of your after-tax disposable income, your savings rate will go down. So we are seeing that.
So as investors in the market, we appreciate the premise of the wealth effect, and now I'd like us to turn to how we consider it at FAM Funds and the analysis that we do on portfolios.
Well, like I said, at Fenimore, we take a bottom-up approach to research and portfolio management. Typically, macroeconomic issues and geopolitical issues don't weigh heavily on our decisions. But we do have a saying, know where you are in the cycle. And that typically pertains to industry cycles, which many of them have. Knowing where you are in the cycle helps you normalize the earnings and the multiple you're willing to pay for a company. But the same is true for the economic cycle.
So I'd imagine that coming off of a really robust 2017 where we saw market highs, that there's a lot to talk about as we look towards the next year.
Absolutely. 2017 was a great year. When you look at the factors that affect earnings power of businesses, GDP growth accelerated. We had unemployment, which was hitting new lows. Job openings were as high as they've been. Inflation was very tame, despite the fact that we've had pretty accommodative monetary policy. Interest rates are still low, despite the fact that the Fed is raising the target rate. And on top of that, you've got consumer confidence, like I said before, at its high since 2001. We don't see any reason for these fundamentals, which is the basis for earnings growth, to be at risk. So when you take that and you add to it the fiscal stimulus that we just got in the form of a tax cut for corporations and individuals, it really sets up nicely for the earnings power of American businesses.
So that's interesting. Within the market last year, we saw that consumers' total net worth increased as well as their real estate and household assets. So because of this, we note that the market for 2018 could see some interesting changes. What is our perspective on the process from here?
So, good question. Let's take a step back and look at just how big of an impact the wealth effect could have. So, in 2017, house prices appreciated, and we saw 20 to 30% increase in the stock market, depending on which index you use. The consumers, the typical household's net worth appreciated 7, 8, 9%, depending. So you have what could be, if history plays out, what could be 1 to 2 percentage points additional growth to GDP in the next year or two, just based on the wealth effect. So how does that affect what we do at Fenimore? It's important indirectly. Every company that we look at, we spend a lot of time valuing the business. And to value a business, we have to figure out how much it's going to earn this year and in the coming years. The base rate on what a company will make is, in most instances, GDP growth. And so when you have these factors that I talked about, which bode for a strong economy, and you add to that the booster shot of the wealth effect, that affects how we value the businesses that we're looking at.
So with all of that momentum at our backs and current valuation, what is our perspective of where we go from here and how all of these impact your portfolio oversight?
So overall, these underpinnings of a great economy, including a wealth effect, give us more confidence in our estimates for revenue and earnings growth in the businesses in general. But then specifically, when you look at some of the more consumer-related names, every business, when you look at some of the more consumer-related names, whether it's retailers that we might own or be looking at, home improvement retailers, home improvement products, leisure items, big-ticket items, these are things that will benefit from both a more confident consumer, a consumer that makes more money, and a consumer that feels wealthier.
So that being a scenario that could play out in 2018, what would happen if market prices decline and we also see the valuation in homes comes down to there be some more substantive interest rate increases?
So that's a good question. There is the wealth effect, and then there is the reverse wealth effect. Generally, you don't see home prices come down, though we did see that in 2007, 2008. More typically, it's when the stock market declines. You do see a reverse wealth effect where consumers will spend less. So that is a risk out there that we do have to pay attention to.
So given that there could be a reverse trend as well with this wealth effect, what we look at Fenimore and FAM is really stock prices and how we can create a valuation that is more conservative than the market. What do we think about the impact of earnings going forward and where we are in this cycle?
So mathematically, a stock price is earnings of the company, or earnings power of the company, times a multiple. What we've been talking about is directly related to the earnings power of a business. If consumers are spending, if they're buying more cars, if they're buying more carpet, if they're buying more clothes, the earnings power of the businesses will grow. That's a very important factor underlying current stock prices and market levels. The multiple is a combination of a lot of things, but basically it's interest rates, which include inflation expectations, and animal spirits. If you look at those three components of stock prices, earnings power, interest rates, animal spirits are high and rising. We're seeing that in the consumer confidence. We're seeing it in investor bullishness. We're seeing it in stock prices. You also, as we've been talking about, have great strength in the earnings power of American businesses. So of the three components of pricing, two of them look pretty darn good right now. One of the things that we are concerned about and we're focused on is the interest rates and what that might do for the multiple. Higher interest rates mean lower multiple. So even if the consumer is spending, even if the economy is still growing, if our inflation expectations lead to higher interest rates and lower multiples, that could cause stock prices to come down despite a good economy.
So Drew, you've obviously exposed to us today that it's an important time right now to be analyzing all of these factors that go into our analysis. If you could help us understand the most important aspects of our discussion so that the investor has confidence in 2018 to move forward with any of their portfolio choices.
So as it pertains to the wealth effect, it's hard to measure, but it exists. It's real and it's been observed. It's affected by both real estate and financial markets, which have been doing very well, and both of those could provide a boost to an already strong economy. This would result in earnings growth that could help the market continue to advance, or at least help the market grow into its current earnings multiple.
So with all of that, we'd love to continue in this bull run and see that the gains in people's portfolios and home assets could continue to contribute to their spending. I'm grateful for your time in the studio today and sharing with us your perspective of the wealth effect.
Thank you for having me, Ann.
Look forward to learning from you down the road and how we can impact investor thinking within our takeaways from different aspects of the market.
Past performance is not indicative of future results. Current performance may be higher or lower than the performance data quoted. Investment returns may fluctuate. The value of your investment upon redemption may be more or less than the initial amount invested. To obtain additional prospectuses or summary prospectuses and performance data that is current to the most recent month end for each fund, please go to famfunds.com or call 800-932-3271. Please consider a fund's investment objectives, risks, charges, and expenses carefully before investing. The FAM Fund's prospectus or summary prospectuses contains this and other important information and should be read carefully before you invest or send money. The principal risks of investing in the fund are stock market risk. Stocks fluctuate in response to the activities of individual companies and to general stock market and economic conditions. Stock selection risk. Fenimore utilizes a value approach to stock selection, and there is risk that the stocks selected may not realize their intrinsic value, or their price may go down over time. And small cap risk. Prices of small cap companies can fluctuate more than the stocks of larger companies, and may not correspond to changes in the stock market in general. FAM funds are distributed by Fenimore Securities, Inc., member FINRA and SIPC.